US markets continue to rise after the Dow Jones finally broke through 20,000 on Wednesday, with President Trump lauding it as a sign of a healthy American economy. Well, James Stanley from DailyFX joins us from New York now. James, it's been threatening this level for a while. Trump's allies have called it the Trump effect. But what really is behind this push through that 20,000 barrier?
Well, just in that question, you mentioned Trump's name 3 times. And I think that's very much the source of a lot of the excitement that we have right now. Really what's driving prices is hope, excitement, maybe even a little bit of euphoria as stock prices have just continued to run since the U.S. election. And, we still have that confluent backdrop of a central bank that's relatively cautious, even though they are looking to normalize policy. And we have the hopes for fiscal policy to actually begin driving some growth in the American economy, which in turn can work out to the rest of the world. So, we're at that very exciting stage of an uptrend, but crossing 20K does mark a psychological price point that does make the index more expensive. Okay. Now, a lot of times folks want to look at these types of levels as, a direct fade level where they just want to open up a short position because they hit 20K. That could be a haphazard way of going about it, because we could see some continued drive above 10K or 20K for a little while. Similar to what happened when we crossed above 10K. We first hit that level in March of 1999. We climbed above in April of 1999, and then we even ran for about 17%. But September of 2001, right back down. We contracted. I believe we went about 30% below that level. So just because we're above 20K, it doesn't mean that we've seen a tidal change here. It's just a psychological price point. Stocks are a little bit more expensive now. And it's another reason to maybe temper bullishness, but it's not necessarily a direct bearish driver in and of itself. So
can it remain then above this level, and for how long?
Yeah, certainly. I mean, it really depends on how that hope continues to filter into markets, right? There is still that questionable backdrop that we discussed the last time we spoke, which is the Federal Reserve is looking to normalize policy. They're very clear about that. And the reasons are very logical. Stock prices are expensive. If we look at Shiller PE ratios, there's only a few times in history when stocks have been this expensive. The one kind of outlier case was 1999. That's when Shiller PE ratios ran up to an all-time high, just a little bit under 45. Right now we're at about 28. So theoretically, we could get a little bit more expensive. And like I said, it's not necessarily a bearish driver in and of itself, just being above 20K. I think what's more pressing is vulnerability, right? Because there's a lot of factors that equate to stocks being exuberantly priced right now. Of course, we have the 20K threshold, Shiller PE ratios, Fed trying to normalize policy, and the fact that this was one of the most unloved rallies in the history of the stock market. Collectively, that makes for an imposing backdrop, especially for investors that are looking to get long in stocks right now. For traders, I think 20K is going to end up becoming an interesting level to work with, first as support and then maybe as resistance if we could break back down.
You said it may have been one of the most unloved rallies, but it was only 42 sessions ago that the Dow first closed above 19,000, and that makes it the second shortest length of time between such milestones. What does that tell us about the market as a whole and what we could see next?
I think this really speaks to the excitement factor, right? That we haven't seen, much of a retracement after clearing 19, and then we just ran straight up to 20. It's that compendium of forces. We have a Federal Reserve that has just spent 8 years, essentially baby walking the economy back into a healthier place. 3 rounds of QE, Operation Twist, TARP. Basically, the kitchen sink was thrown at this problem. And now we have the hope for fiscal policy to drive growth, So it's almost as if this was something that markets have been waiting on for the past 8 years, didn't get, now they have it, and now they're just running. 42 days between 19 and 20, that's a heck of a run in a really short period of time. And really, it's all driven by the excitement from this post-election backdrop. It doesn't necessarily mean that it's different this time. It just means that hope is driving markets at the current, similar to how it was in April of 1999.
And it's not just the Dow that's running, as you put it. We've also seen new highs, of course, the S&P and the NASDAQ. What levels should traders be watching for there?
So first off, I think that professional traders generally want to take heed when these all-time new highs or lows come in. And again, you don't necessarily want to use that single iteration of data or innuendo to drive an entire trading strategy. Instead, I think it's important to confirm that these new highs are going to hold. And the way that we could do that is by looking at these prior points of resistance, waiting for support to develop. If it does develop, then we could look at a continuation strategy, looking to go in that direction. So like, for instance, on the Dow Jones, let this thing run, wait for it to pull back, and then once it pulls back, see if you can get support at 20K. If you can, that could afford a tight stop so that you could look for that continuation play. And if it doesn't work, you get that tight stop hit. Now, if it does break down below 20K, this is when we can start to use that level as a point of resistance. And that's what could be maybe a little bit more exciting on the prospect of trading reversals. Because when hope gets really built into a market, anybody that does want to buy already has bought. And eventually we're going to get to a stage where there's not many buyers left on the sidelines. So even if there's good news to drive prices higher, if there's nobody left to buy, then prices won't go up. And that's somewhat of the fear that we might be running into as hope really is taking markets by a storm. Second half of this year, we're going to hear the Federal Reserve likely trying to kick rates higher. I think probabilities this morning were about 75% for a hike in June. Fed's already said they want 3 in this year. If they really do get 3, it's hard to imagine that we're not going to see at least some pressure build in equities.
Okay, James, thanks very much for that. James Stanley there from DailyFX with his take on what he's made of this break above 20,000 for the Dow and whether we could see it continue.